Good evening, everybody. On behalf of Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the today's webinar series on UPSC ICoAS preparation for newly qualified cost accountants. Our today's speaker is CMA Rashmi Mudgal ma'am. She is the practicing cost accountant. Now I welcome ma'am and all the participants. Now I request ma'am to kindly start the session, ma'am. Thank you.
Okay. Hi everyone. Good evening. Am I audible?
Yes, ma'am.
Okay. Okay. Let's start the session with PPT. One second. Today we are going to discuss about financial statement and analysis. What exactly the financial statement and what is the analysis? I have an idea that you know this thing because you are all are qualified cost accountant. So I am giving you a little glimpse of the financial statement as well as analysis within example which I have recorded from the Yes Bank and Tata TCS. So that will be the case study in the end of this session. So I hope and I invite you for the questions as well as I would like to have a participation with you also from your side. Today we are going to take financial statement to another edge where we are going to compare the different kind of what financial statements are, why they are together as together need to be harmonized. Okay, so what exactly table of content is there? Introduction, we are going to discuss financial statement, ratio analysis, and cash flow statement. We have covered cash flow statement yesterday's session when we actually take care of the accounting in AS. We are going to take a glimpse of it today because we don't want to repeat it again and again, but we are going to discuss it thoroughly with other aspects. Okay. So firstly, I would like to tell you that the central focus on financial analysis is evaluating companies' ability to earn a return on capital that is least equal to the cost of capital. Okay. To profitably grow its operation and generate enough cash to meet the obligation of pursue the opportunities. Okay, so financial analysis is a process of examining a company's performance in context of the industry and economic environment in order to arrive at a decision or recommendation where I wanted to see is the company is making any profit or not. And if this company is making profit, is this comparable to the other company of the same industry? For example, if I am taking a profit of Hyundai, I will compare it with the Tata or maybe Maruti or maybe Honda. So if Hyundai is making profit of 10%, if can I compare it with the Maruti? Because Maruti is making profit 15%. So why they are making less profit? What is the reason behind it? So this will be taken care with the financial analysis. Okay. So often somewhere we actually take recommendation. Sometimes we offer decision and recommendation addressed by the financial analyst. So what we do, we actually take a decision. Do we need to give them a loan? Do we need to give them a Our share capital, do we need to buy their equity? It is totally depend upon when we actually analyze the share. In the new era, it is actually depend upon the demand and supply, but fundamentally it should be on the financial analysis. Okay, because if the finance of a company is strong enough to compete or to survive in the market, they will not dependent upon mere demand and supply rule in the industry. Okay, so here we are going to see whether to invest in the company or in the debt or equity. There could be possibility the equity has a return of 5%, but debt they are paying 9%, 10%. So at what price we can invest in this company? Okay, an investor in debt security is concerned about the company's ability to pay its interest, to repay the principal lent. An investor in equity securitize its owner with the residual interest in the company and concerned about the company's ability to pay the dividend, likelihood that a share price will increase. Okay, so basic financial statement analysis are presented in the reading provision on a foundation that enables the analyst to better understand other information gathered from the research beyond the financial reports. So beyond the financial reports, what I can see, they do have debtors. Okay, how many time they are get, how many time debtors takes to pay their debt. So these things also can be taken care with the financial analyst. Okay. Next, what is a financial statement analysis? What is actually a financial analyst analysis? Financial statement analysis is a process of analyzing a company's financial statement for decision making purpose. What kind of decision? There are several decisions. Mostly people actually consider the financial statement to see whether I need to invest in the company or not. Second, whether I should join the company or not. There could be possibility they will shut down in 2 months. I am leaving my job, which is high paid, and I'm leaving this job for that company, which is about to go down within 2 months. So after 2 months, what will I do? Okay, so external stakeholder of the company, maybe bank, maybe shareholder, maybe creditor, debtor, actually may use it understand the overall health of the organization. If the company is healthy, are they have assets against their liabilities? Okay, and to evaluate financial performance and business value, internal constituent use its as monitoring tool for managing the finances. Okay, so that is taken care by the, what is the key takeaways with the company, with the financial analysis? What we do actually, what we, three things what we do with the financial analysis and what is the output of the financial analysis. First is financial statement analysis is used by internal and external stakeholder to evaluate business performance and value. Okay, second is financial accounting call for all companies to create a balance sheet, income statement, and cash flow statement, which form the basis for financial statement. Okay, last is horizontal, vertical, and ratio analysis are three techniques that analysts use when analyzing the financial statement. So these are the techniques we are going to discuss about the horizontal and vertical and ratios. We are going to discuss about the financial statements and financial analysis today. Okay. Next, we are going to discuss about the how to analyze the financial statement, how we can go to how we can compare them. So firstly, we have to see are they are taken into the way when the gap has prescribed some rule, the NDS has prescribed some rule, are they following them? So that it becomes very easy to compare it with another company of the same industry or maybe in the other industry also. It's not always to see the same industry. Sometimes I wanted to know the profit making industry also. So even if you are a good in your own industry, but it can possible that economy wise you're not that good, you're not that bright. Okay, the financial statement of the company record important financial data on every aspect of business activity. As such, they can be evaluated on basis of past, current, and projected performance. In general, financial statements are centered around generally accepted accounting principle gap in US. Okay, United States ने बना के रखे हैं already gap. We are actually following them only. These principles require a company to create and maintain at least three main financial statements. One is balance sheet, one is the income statement, which is popularly known as profit and loss account, then a cash flow statement. Public companies have stricter standards because the company has a capital of the public only. Public has invested in that company. The normal people of the country invest in that company, so they have to be little vigilant about what they are doing. Okay, so they are more stricter standards for the financial statement reporting. Public company must follow gap, which require accrual accounting. They cannot go for the cash based accounting, they have to go with the accrual accounting only. Okay, private company has a greater flexibility because private company में promoters का पैसा लगा होता है, so companies definitely go with their own rules. If the shareholder is happy, the other stakeholders are happy, because stakeholder number of stakeholder is less into the private company in compared to the public company. Okay, in their financial statement prepare and have option to use either accrual or cash accounting. So, however, they have an option of taking this advantage, but it is recommended that we should always take a accrual based accounting. In exception is always there, but yeah, accrual is always taken care that this expense is related to this production or this period. We have to book it into this period and this expense. Okay, so several techniques are commonly used as a part of financial statement analysis. Three of most important techniques are horizontal analysis, vertical analysis, and ratio analysis, which we are going to discuss in the today's webinar. Okay, we horizontal analysis compare data horizontally by analyzing value in the line across two or more years. Why we are comparing ourselves with the previous ourselves. So we are what we are doing, we are actually checking this year we have a sale of 100 CR, but last year we have a 110 CR. So why we have moved low in this sale, we can compare it across the years, what we have performed in the last year, 2 years, 3 years, 4 years, whatever the are wanted. But yeah, in the everything is good scenario, we actually take 2 years comparison, current year and previous year. In the vertical analysis, look at the vertical effects of the line item have on other parts of the business and business proportions. So I am in the vertical, what I'm doing, I am doing other parts of business. I'm doing a comparison between other business lines with the my own business. In the ratio analysis, used important ratio metrics to calculate statistic relationships between the assets, between the sales, sometimes between the payment period, sometimes with the raw material. We actually go with the relationship, what we have a relationship with the another thing. For example, how much assets we have against liabilities of such amount. So this relationship when we are calculating, that is known as ratio metrics and ratio analysis. Okay, next is types of financial statement. What are the types? I told you that balance sheet, income statement, as well as cash flow statement. The company use balance sheet, income statement, and cash flow statement to manage the operations of their business and to provide transparency to their stakeholders so that they can understand that we are getting this much profit, how much dividend they are distributing, how much amount they are keeping it with their reserves. So this has been taken care by the financial statement where they declare everything. All three statements are interconnected. Okay, everything is interconnected, create different view in the company's activity and performance. So we do have a different views in all three of statements. Okay, in the income statement, I will get to know that how much profit we are earning. In the balance sheet, we are going to know about the assets and liabilities. In the cash flow statement, we will see that profit as per P&L is different, and the profit I have realized, which is in my hand, is a different. So, what is the cash available to meet my daily expenses as well as to encourage my uh, future opportunities? Somewhere in cash my future opportunity, I need a somewhere of money, a cash and cash equivalent, just to invest in that. Okay, all three segments are interconnected. Okay, balance sheet is a report of a company's financial worth. So we are actually looking कि मेरा company का worth क्या है. It is broken into three parts, include the company's asset, liabilities, and shareholders' equity. Short-term assets such as cash and cash account receivable can tell a lot about the company's operation efficiency. Okay, so if I do have a good cash or debtors, it means I do have a good sale and I do have a capacity to meet any expenses which may occur. Okay, short-term assets, any short-term asset can make this operating efficiency. Okay, liability includes the company's expense and arrangement, and the debt capital it is paying off. Okay, and shareholders equity include detail on the equity capital investment and retained earning from the periodic net income. The balance sheet must be balanced asset and liabilities to equal to the shareholders equity. So they are saying that assets and liabilities to equal to the shareholders equity, it should be into the financial and statement. Okay, the figure of considered a company's book value and serves an important performance metrics, and that increase or decrease with the financial activity of the company. Okay, so that is the balance sheet. Now comes to income statement and cash flow statement. So income statement, what income statement breaks down into revenue, that is company earn against expenses involved in the business. Okay, so provided a bottom line, meaning net profit or net loss, where we actually understand that how much profit we have made around the year and how much loss we have faced around the year. So we can discuss it, ki how much sale we have made, how much expenses we have made, and what are the profit and loss we are getting after making all the efforts. Okay, the income statement is broken into three parts that can analyze business efficiency in different points. Okay, it begins with the revenue and direct costs associated with the revenue to identify gross profit, then move to operating profit. So what they are doing, they are making a profit and they are calculating the profit from the business only. Okay, which subtract indirect expenses like marketing cost, general cost, depreciation. Finally, after deducting interest, taxes, net income is reached. Okay, this is the way how we calculate the net profit. Okay, next we comes to basic analysis of the income statement. Usually involves the calculation of gross profit margin, which we actually see for, our operating profit margin, and net profit margin, which each divides profit by revenue. Okay, profit margin helps to show the company's cost and low or high at the different point of the operation. Okay, cash flow statement. The cash flow statement provides an overview of the company's Cash flow from operating activities, investing activities, and financing activities, net income is carried over the cash flow statement, where it is included as the top line from the operating activities. Like its title, investing activities include cash flow involved from the firm-wide investment. Okay, and from the financial activity, we are getting the cash from both debt or equity. Whatever we are getting from there, we are putting it into the financial financing activities. The bottom line show how much cash a company has available. So these were the statements. These were the statements. Okay. Now comes to the okay. Okay, now comes to the free cash flow and other valuation statements. Okay, companies and analysts also use free cash flow statement and other valuation statement to analyze value of company. Free cash flow statement arrives at the net present value of the discontinue by discontinuing the free cash flow that a company is estimated to generate over the time. Okay, private company may keep a valuation statement as they progress towards potentially growing public company. So they have to take care of it if they are going to be public company. Okay, next, financial performance. How we will see financial performance after financial analysis. Only this is the main goal to get it done. Ki what at what stage right now I'm at in my business or in the industry or maybe into the economy. This has to be taken care with the financial analysis. Okay, when doing compass comprehensive financial statement analysis, analysts typically use multiple year of data, facilitate horizontal analysis, where they actually think that my competition is with me. My competition is with me. So what they do, they take their own data of last years or maybe 1 year, maybe 2 years and more. Okay, these are also taken. Each financial statement each financial statement is also analyzed with vertical analysis to understand how different category of statement are influencing result. So every department profit, every department's different kind of operating profit as well as net profit is to be taken care in this statement. Okay. Finally, ratio analysis can be used to isolate some performance metrics in such statement and bring together data point across the statement collectively. So what they do, they actually do firstly financial statement horizontally, vertically, and then they comes with the performance metrics with the uh, ratio analysis. Okay, this is how it works. Now we come with the most common ratio metrics. Firstly, the balance sheet, income statement, cash flow. Okay, balance sheet, we all know that it take care of the ratios of asset turnover ratio, quick ratio, receivable turnover ratio, days to sale, debt equity. These all are balance sheet kind of ratios. Okay, income statement is a more of a profit margin ratio, operating profit margin ratio, tax ratio, efficiency, and interest coverage. Next is cash flow. Actually, cash flow, what they do, that tells us about the earning before interest, tax, depreciation. Okay, so they give us this matrix which shows per share basis, per share basis. Okay, comprehensive actually include return on asset, whatever return I'm getting over this much asset I have employed on it, and return on equity along with the DuPont analysis. Okay, this is the analysis. What are the advantage of financial statement analysis? क्या advantage क्या है इनको देखने के, इनकी कोई एडवांटेज है कि नहीं है? The main point of financial statement analysis is to evaluate a company's performance or value through a company's balance sheet. Firstly, we will look after the company's balance sheet, economic statement, and cash flow statement. Okay. By using a number of techniques such as horizontal, vertical, and ratio analysis, investor may develop more nuanced picture of the company is a financial profile. So here we can see there are two people who do have three ways, but they can see that yellow one is indicating something different. What they are different, we can actually analyze it from these three techniques. Okay. What are the different type of financial statement analysis? Okay, most often analysts will use three main techniques to analyze the financial statement, which is horizontal, vertical, and finally ratio analysis. Horizontal, we all know it is different time period. Vertical, what they do, the financial statement in relation to each other. For instance, expense item could be expressed in percentage of the company's sale. Okay. Finally, the ratio analysis, what they do, they compare the line item, price to earning, earning per share, or dividend yield. The examples of the ratio analysis. Okay. What is an example of financial statement analysis? Why we need it? For example, gross profit margin will show the difference between the revenue and the cost of goods sold. Okay, if the company has a higher gross profit margin than its competitor, this may indicate a positive sign for the company. Okay. At the same time, the analyst may observe that gross profit ratio has been increasing over 9 fiscal period. Okay. In the 9 year, applying the horizontal analysis to the company's operating. So this is what happens into the financial statement analysis. An analyst may first look at the number of the ratio on the company's income statement, but determine how efficiently it generates the profit and the shareholders value that is done. Okay, importance and uses of ratio. What is the importance and ratio of the importance of the ratio? Firstly, we need to understand that ratio analysis is important for the company to analyze its financial position, liquidity, profitability, risk, solvency, efficiency, operation effectiveness, and proper utilization of fund. It also indicates the trend of comparison of the financial result help into the decision making for investment by the company's shareholder. It helps us to compare the trend of two or more companies over a time. So what is main importance? Firstly, I will say I can plan my future. I can plan my forecasting of the company. I can compare the performance of the companies, two companies, or maybe with the previous data also. I can identify the risk also, financial risk or maybe business risk I can identify for the company. Okay. It also helps to know the profitability of the company. Are they getting, we are getting 20% of our sales or 20% of our net asset. What is the profit after employed this much of asset? Okay. Analysis of financial statement also, we can do this. Also, we can see that operational efficiency of the firm. Okay, these are the importance of the financial analysis, which we are going to discuss one by one. There are 8 importance. First is analysis of financial statement. Simply, we will analyze. Second, help in understanding the profitability of the company. We are actually able to see are they profitable to the company or not. Okay. Next is analysis of operational efficiency of the firm. Are the companies operating at a good level? Are they getting a good asset recovery? Okay, and they are getting a return on investment, a good liquidity of the firm. From the cash flow statement, we actually get to know that liquidity of the company, and sometimes by the payback period ratios, we actually get to know how much days it takes to get a payment for the working capital requirement. Okay, also helps in identifying the business risk of the firm, helps in business risk you can identify of the firm. Next is identify the financial risk of the firm. So we are covering in the ratios that business risk as well as my financial risk of the business. Next is for planning and future forecasting of the firm. So what we are doing, we are making planning for futures also. Okay, by this data. Next is compare the performance of the firm. We can compare our performance with ourselves as well as compare with the world or country's best companies what they are doing. Okay. Okay. Next, we are going to analyze the financial statement. What they do, they have types of ratios. This is solvency ratio. Okay, solvency ratio has a liquidity ratio as well as turnover ratio, operating performance ratio, efficiency ratio, and profitability risk, business risk, financial risk, external liquidity risk, and growth rate. So, analysis of financial statement actually takes ratio analysis also. Okay, interpretation of the financial statement and data is essential for the firm's international and external internal and external stakeholders. Okay, equity investors are more interested in the growth of the dividend payment and earning power of the organization in the long run. Creditor may like to ensure that get their repayments on their dues on time. Okay, with the help of static analysis, we interpret the number from the balance sheet and economic statement. Every stakeholder has different interest when it comes to the financial result. Okay, this is the analysis of the financial statement. Okay. Now comes it helps in understanding the profitability of the company. When we actually think about the gross profit margin, we can discuss about the what is the profitability. Here I have put a chart month wise. I have put a chart of the month wise where we can see that month year wise where we can see every December on 2008 2009 we in the 2008 from 2008 to 2009, there is a drastic increase in my gross profit margin. But after 2010, there is a substantial gross profit decrease. Okay. And we can see here that there is a stability in 2020, 13, 14, and 15. Okay. So what the profitability ratio helps to determine the profit of a firm, return on asset, return on equity helps to understand ability of a firm to generate earning. Okay, return on asset is also there. Is a total income divided by total asset. What is the total income and divide by total asset? It means how much a company earns a profit for every dollar of a purchase. Return on a equity is net income by shareholder. Okay, so this ratio tells us how well a company uses its investors' money Ratios like gross profit and net profit margin helps to analyze firm's ability to translate sale into the profit. Sometimes we do have a sale of 100 crore, but profit is like 5 lakh rupees. So one can be one can be impressed by the data that they are getting a sale of 100 crore, but one can also understand that 5 lakh rupees over a 1 CR is very less. Okay. Next is analysis of operational efficiency on the firm. Okay. This is also there. Okay. Certain ratio help us to analyze degree of efficiency of a firm. Ratio like account receivables turnover, fixed asset turnover, and inventory turnover. These ratio can be compared with the other peers in the same industry and help analyze which firm is better managed, which firm is better managed. Okay, so this can be also seen here, where we can see is this the company is well managed with the people around it or not. Those ratio can be compared with other peers in the same industry, where we can see the same industry is giving the same result or not. Okay, so these ratio are comparable as well as give them a help to analyze the firm better manage. Second, it is measured a company's capability to generate income by the using assets. Third, okay, it took at various aspects of the firm.
You're not audible, ma'am.
Am I audible?
Yes, ma'am.
Okay. So, second, we measure the company's capacity to generate income by using assets. Third, it took at a various aspect of the firm, like the time generally takes to collect the cash from debtors or a period for a firm to convert the inventory to currency. Okay. It is why efficiency ratios are critical and improvement will lead to growth and profitability. Next, we are going to discuss about the liquidity of firm, where we can actually think about how easily we can get a cash into asset into our cash. Okay, so there are so many examples of liquidity ratios, our current ratio, quick ratio, cash ratio, as well as there is a turnover ratio where we actually see what is the time it takes to become one inventory to become a fixed goods and sale, as well as we get the money back in some days. Okay, so these are the example like receivable turnover ratio, days receivable, inventory turnover ratio, days inventory, accounts payable turnover, days payable, cash conversion cycle. So working capital cycle is also taken into the account where turnover ratios are measured. Liquidity determines whether the company can pay its short-term obligation or not. Okay, so if I'm able to pay anything or EMI, monthly EMI, salaries on time, on days, so it is I am fulfilling my obligation, short-term obligation on time. Okay, so we mean short-term obligation, short-term debt, which one can pay within 12 months on the operating cycle. Okay, for example, the salary dues, sundry creditors, tax payable, outstanding expenses, etc. Okay, the current and quick ratio measure the liquidity of the firm. Measure the liquidity of the firm. The ratio analysis also helps in identifying the business risk of the firm, where we can see is the company is making any profit or not, are they are risky or not. We can see in the mutual fund and share ratios, where we can see that there are red marks. How these red marks are calculated by these ratios actually. One of the most important reason to use the ratio analysis is to helps to understand the firm's business and calculate the leverage, financial leverage and operating leverage, and we actually see that how much a financial risk is with the company or with how much a business risk with the company. Business risk is totally depend upon the profit, is totally depend upon the profit, what profit we are making into this by manufacturing a particular goods and services. Okay, so what happens, how its profitability is sensitive with the fixed cost deployment and outstanding debt. So here in the you can see there is a vertical comparison, vertical technique has been used for the years till 2015. Okay, so we can see there was a sales was 7.2% negative of the operating leverage as well as financial statement. So we can see operating leverage is percentage change in earning before interest and tax and change in the sales. So this is a negative mark for this. So we can somewhere understand there is a business risk which we are going through in this business. So we can take an informed decision. That is not something if we will withdraw our capital and everything. We will see, is this a risk I can handle or not? Or do I need to invest more because this is a risky item, people uh, might get out of the industry. Okay, so this is also an opportunity. So it is totally depend upon the risk behavior of a investor. Okay, next comes to the helps into identifying the financial risk of the company. A company का financial risk, how to get to the financial risk? In financial risk is, are they able to pay their uh, interest, dividend, everything which is related to the financial risk? Okay, are they are able to get, like, you have heard about that loan is not sanctioned because of this and this and this. That is financial risk with you is high than the income from you. Okay, so financial risk, another important ratio analysis is that helps to identify the financial risk. For example, ratios like leverage ratio, interest coverage ratio, DSCR ratio, etc. help the firm to understand how it depend upon the external capital and whether repay the debt or using its wealth. Okay, so they can understand that the firm is totally depend upon they do have a profit, they actually do have a profit or not. Firstly, they do have a capital or not. Are they totally depend upon the loans, or the loan interest is more than the return on equity? So these things can be taken care with the this ratios. Okay, so these ratio can be understand by this map also, where we can see current portion of long term debt is there and deferred income taxes are there. This is payable. Okay, and total equity share is 1385. So the equity is less than my liability. So that means we can see the firm is totally somewhere depend upon the external capital, because my own capital is very less and debt equity ratio is also very less in this scenario. Debt equity ratio should be 1:1 in the is a ideal case. Okay, next, for planning and future forecasting of the firm, we can understand, do we need to go with this or not? Are we getting a profit out of it or not? So here what we see, we actually can see here vertical vertical comparison of the cost of sales, gross profit. So we can see in 2010, there was a gross profit ratio was 40%, and in December it is 41.5%. So it is increasing. It is increasing. My profitability is increasing. Okay, but selling general and administration expenses are also increasing. I can see this. Income before income tax is going down. So we can see here the cost as well as the tax also. Okay, so net income is decreasing from 14.9 to 14.5. Okay, so we can see here the gross profit is increasing, but net income is decreasing due to my administration cost as well as tax expenses. So net income attributed, we can see here that is also decreased. So we can understand, do I can forecast that how much sales can be increased by this method, as well as I can see that tax expenses increasing by day. So I have to see, is this provision for income tax I'm increasing. So I have to see here that my operating profit is decreasing, and I have to also look after the administration expenses, which has increased. Okay, so in this analysis, and manager can find a trend, use the direction of future ka direction they can see by forecasting, be used for the critical decision making by the external stakeholder like investor. Example, they can analyze whether they should invest in the project or not. Are the project is worthy enough to take this much risk? Are I am okay to withdraw the capital from the current project and putting it into the different project? Okay. So this is also taken care with the forecasting. This is also a very last to compare performance of the firms. Okay, here what I do, I see here different parameters where I can see that these are the companies and these are the their prices. Okay, so for the sales store, this is 56. LinkedIn, this is 196. So I can see my cost of buying this share will be higher, but what profit I am making, this can be taken care by. So by this, I can see this is a very marginal increase in the profit, but there is a much more, almost 4 times of the investment I am making for the $1 of the profit. So here what I see, I can see it along with the other companies also, that I am investing on one share this much, the market price is this, earning yield is this, and release is also this. So what I can see here, that earnings as well as price as well as my revenue growth for the years, by the years, my gross profit margin, my R&D expenses, everything is given by the industry. So what I can see here, my median, mean, low, high, what I can compare with what favorite company I am working with. Okay, so there could be one company which is giving you a good earning yield, but there could be possibility their gross profit margin ratio is less. So how they are getting this profit? There could be possibility that they are getting profit by selling their assets. The capital gain is also taken care in the books of accounts and it has been distributed, or other income by the rent or maybe investments in other companies and firms are making them profitable, not the primarily business. Okay, so this was the compare of the firms when we go to the horizontal comparison. Okay, conclusion, what we are going to say, as we have discussed the importance and use ratio analysis, so it's vital to assess the performance of the firm by analyzing the liquidity, profitability, asset management, and efficiency ratio. The ratio analysis are for making important decision as well as forecasting the future. Okay, so we are taking you to the these two these two okay. So I am taking you to this Tata Consultancy Service Limited, where we will discuss about the, I will show you how the financial analysis work as a chart. So this is the TCS financial summary, where we can see here. the Tata Consultancy Limited reported earnings also of quarter of 31st March 2024. Fourth quarter ko they have declared this. Okay, so we have concluded this with this that in the total revenue in the June 23 was 593. In the September 23 it was 596. In December 23 it was 605, and in March 24 it was a 623 billion. Okay, so we can see here the graphical as well as gross profit margin, which is 40%, and operating margin was 24%. Net profit was 19%. Return on investment is 40%. So here we are able to understand that the company is doing great. The company is doing great. Okay. Also, is there any question till now? Okay, let's see if we go to the total revenue, gross profit, operating income, as well as net income by the quarters also. It has given us a quite a good picture where we can understand the profitability, net income, and everything. After that, we are getting the TCS balance sheet, where we are balance sheet is more of the liquidity ratio. What is the quick ratio? What is the current ratio? So we can see here they are doing ideally great. They do have a better assets than the liabilities. So they are doing better in the finances. Okay. So total debt equity ratio is also good in the number. Total assets we can see here in quarter we have seen the increase. We have seen the increase into the total assets also. In total liabilities also there is an increase. Now comes to the cash flow statement. So we can see here the cash flow statement where operating activities I'm getting a cash of a 98.8 billions. It is amount in billions. Investing activities are there. Financing activities is not here. They have a negative. That means they have paid their debt off. They have paid their debt off. So they do have a net cash flow also here by the year. So we can see here there is a huge analysis of a Tata consultancy where we can see there is a share price is also increasing because of this also. This was a financial. This was a financial data analysis. On the other hand, if I go to the second thing, which is yes when, which is yes when I'm taking you to. Now we can see in the Yes Bank data, okay, so we can see here that net profit margin is 5.6%. Sorry, increased by 5.6%. That is a comparison from the last year only, So we can see here the interest income in 22 and in 21 has been increased by 5.1%. Okay, sorry, decreased by 5.1%. Other income has increased by 9%. Interest expense is decreased by 0.7%. So here we can see the comparison between the expenses as well as we can evaluate them as per the increase and decrease and changes into the network, advances, deposits, everything is taken care by this. Next we comes to the earning per share. Earning per share was firstly 8 rupees, now it's 7 rupees. So we can see this also. Now comes to the credit deposit ratio is also there, which has been decreased, which debt to equity ratio also increased. That is a good sign. Loan deposited is same. Capital adequacy is almost the same. Return on equity, last year it was into a loss, but now it is into the profit. So we can see here the comparison is horizontal. Okay, where we can also see the net interest margin, net profit margin. So in the financial year 17-18, the net profit margin was 20%. And after in 19, after COVID, we have seen a very fall into the 2021. Okay, so in these areas, we can see they are into a huge loss where their percentage is going down into the net profit margin. But in the financial year 2022, we can see this is 5.6% as a net profit margin. So we can see here that the company is improving. So is this okay to put some funds, park some fund here? So it is always totally dependent upon the risk taking capacity of the investor. I hope you understand this analysis. Is there any questions? Okay, I'm concluding this webinar with this last, and I hope to see you tomorrow. And is there any question? Okay, thank you for joining me.
No questions, ma'am. So we can conclude the session.